On December 5, 2025, RBC Capital Markets made a notable move by downgrading Bank of Ireland Group, also known as Berg, from an Outperform rating to Sector Perform. This decision caught the attention of investors and analysts across the financial sector. It's important to note that this isn't a panic signal or a sign of looming trouble. Instead, it's a shift in expectations. RBC now sees the stock as likely to perform in line with its banking peers, rather than outpacing them as it previously did. The downgrade reflects a more balanced outlook, rather than a negative one. The main reason behind this reassessment: stretched valuation metrics. RBC believes the stock price has climbed too high, too quickly, making it look expensive compared to both its own historical averages and to similar European banks. When a stock's valuation gets ahead of its fundamentals, it often signals a period of slower growth ahead. Interestingly, just a month earlier, RBC had upgraded the stock, which highlights how quickly market sentiment and analyst perspectives can shift in response to changing data and market conditions. The bank's underlying fundamentals remain solid, with strong balance sheets and stable operations. However, the price investors are now willing to pay for those fundamentals has risen sharply, making the stock less of a bargain than it once was. RBC's message is clear. Bank of Ireland is still a robust and well-managed institution, but the period of easy, outsized gains may be behind us for now. Investors should be aware that the risk-reward profile has shifted. This is a moment for investors to pause and re-evaluate their positions. Even great companies aren't always great buys at any price, and it's crucial to consider whether current valuations justify new investments. RBC isn't forecasting any immediate trouble for Bank of Ireland. Instead, they're simply advising more tempered expectations for future growth, suggesting that investors should be cautious and realistic about potential returns. The stock's journey ahead may be steadier and less dramatic than before, so investors should consider adjusting their strategies to reflect this new, more measured outlook. Valuation metrics are essential tools that analysts use to determine whether a stock is cheap, expensive, or fairly priced in the market. These metrics help investors make sense of complex financial data and guide their decisions about buying, holding, or selling shares. Think of valuation metrics like comparing house prices in a neighborhood. Just as you wouldn't buy a house without checking what similar homes are selling for, investors use these metrics to compare stocks within the same sector or industry. Two of the most important metrics highlighted in RBC's report are price to earnings, PE, and price to tangible book value, PTBV. These ratios are widely used to assess whether a stock is trading at a reasonable value. The PE ratio is calculated by dividing the stock price by its earnings per share. It tells you how much investors are willing to pay for each dollar of earnings. A higher PE typically means investors expect higher growth in the future, so they're willing to pay more now in anticipation of bigger profits later. On the other hand, a lower PE can signal that a stock is undervalued, or it might indicate that the company is facing challenges or slower growth prospects. RBC points out that Bank of Ireland's forward PE is now about 10% above its historical average, suggesting the stock is getting pricey compared to its own past. The PTBV ratio, meanwhile, compares the stock price to the value of the bank's tangible assets, things like cash, property and equipment, minus intangible items. For Bank of Ireland, this ratio is now 1.35x, which is a hefty 80% above its 10-year average, another sign that the stock is trading at a significant premium. These elevated numbers show that investors are currently willing to pay much more than usual for Bank of Ireland shares, possibly betting on continued strong performance. Smart investors always look at these metrics in context, comparing them not just to a company's own history, but also to its competitors and the broader market. RBC's conclusion is clear. Bank of Ireland's stock price has outpaced its underlying fundamentals, meaning the price may have run ahead of the company's actual performance. That's why they're urging investors to be cautious and not get swept up by momentum alone. Ultimately, valuation isn't just about crunching numbers. It's about understanding what you're really getting for your money and making sure you're not overpaying for future potential. RBC's report includes a price target, the level they expect the stock to reach in 12 to 18 months. For Bank of Ireland, that target is $15.50 per share. But when RBC downgraded the stock, it was already trading at £16.07, above their own target. This signals RBC sees the stock as fully valued, with little room for near-term gains. Price targets are educated estimates, not guarantees, based on deep analysis and financial modeling. RBC's $15.50 target reflects their expectations for the bank's earnings, costs, and growth. For investors, the takeaway is clear. The stock may not have much upside from here. Price targets help frame expectations and guide decisions to buy, hold, or sell. In this case, RBC is signaling it's time to be cautious. To judge if Bank of Ireland is expensive, RBC compared its current valuation to its own history and to competitors. The bank's P/TBV is now 1.35x, compared to a 10-year average of just 0.75n, an 80% premium. Its PE is also about 10% above its historical average. Historically, Bank of Ireland traded at a discount to peers. Now it trades at a premium. This shift from discount to premium is a red flag for value-focused investors. It means optimism has pushed the price above both its own norms and those of rivals. When a stock is pricier than its past and its peers, it's hard to argue it's a bargain. That's the core of RBC's concern. The downgrade is rooted in valuation, not business fundamentals. Despite the recent downgrade, RBC isn't turning bearish on Bank of Ireland's business prospects. In fact, their analysts remain optimistic about the bank's underlying strength and future earnings potential, even as the market sentiment shifts. RBC expects Bank of Ireland to outperform current profit forecasts, projecting nearly $2 billion in pre-tax profit for 2026, well above what most analysts anticipate. This confidence is rooted in the bank's robust balance sheet, resilient customer base, and its ability to navigate changing economic conditions. This positive outlook continues to support the stock, even at a relatively high valuation. Investors are watching closely, as strong earnings can justify premium pricing. RBC's sector perform rating reflects a tug of war. On one hand, the high valuation limits further upside, but on the other, strong profits provide a solid safety net for shareholders, reducing downside risk. The most likely outcome? The stock is expected to perform in line with the broader sector, rather than significantly outpacing its peers, as the market has already priced in much of the optimism. The main reason to stay invested is the potential for analysts to raise profit forecasts as the year unfolds. If the bank continues to deliver, upward revisions could provide fresh momentum for the stock. For investors, the message is nuanced. The business remains fundamentally strong, but the current price already reflects much of the good news, making it important to manage expectations. The downgrade isn't a reflection of management or strategy. It's about weighing risk versus reward at today's elevated price levels and recognizing that future gains may be more modest. Bank of Ireland remains a solid institution, but investors should keep their expectations realistic and be prepared for a steadier, more measured pace of growth. Ultimately, the stock's next move will depend on both continued profit delivery and how the market values those earnings in the months ahead. RBC doesn't just rate Bank of Ireland, they compare it to its main rival, Allied Irish Banks, AIB. RBC prefers AIB, citing higher dividend and total return yields, plus more excess capital for buybacks or growth. AIB's stronger market share, better loan growth prospects, and larger provisions for loan losses make it more resilient. RBC also sees more potential for AIB to beat profit forecasts. The key question isn't just, is Bank of Ireland good, but is it the best option? RBC's answer: AIB currently offers a better mix of value, returns, and growth. For investors, AIB is the preferred play in Irish banking right now. Let's look at the numbers behind Bank of Ireland. As of December 2025, its market cap was about $15.5 billion, with 964 million shares outstanding. The dividend yield stood at 3.9%, offering steady income even if price gains slow. The bank's Common Equity Tier 1 (CET1) ratio, a key measure of financial strength, was a robust 14.6% in 2024, projected to stay strong. RBC forecasts a net interest margin, NIM, of 2.68% for 2025, a core driver of profitability. Cost growth is expected at 3%, and the cost of risk at just 0.29%, both manageable. These figures show a stable, well-capitalized bank. The fundamentals are solid, but the stock's price already reflects much of this strength. For investors, the numbers support the view that Bank of Ireland is steady, not spectacular. The financials back up RBC's more cautious stance. RBC highlights several risks for Bank of Ireland investors. First, interest rate sensitivity. If rates fall, profit margins could shrink. Second, rising competition from digital banks and fintechs could pressure fees and margins. Third, the bank's high operating costs, legacy systems and a big branch network could eat into profits if not managed. Fourth, lagging technology could make it harder to attract customers and stay efficient. These risks could limit growth or erode profitability. Investors should keep a close eye on rates, competition, costs, and tech upgrades. No investment is risk-free. Awareness is key. RBC's scenario analysis outlines both downside and upside cases for Bank of Ireland's stock. In a downside scenario, if loan growth stalls, bad loans rise, and competition intensifies, the stock could fall to $11. In a more optimistic case, with resilient margins and strong execution, it could reach $17.50. The likely outcome is somewhere in between, shaped by the Irish economy, interest rates, and the bank's strategy. For investors, the lesson is clear. Understand the range of possible outcomes and the key drivers. The future is uncertain, but informed decisions start with knowing the risks and opportunities. RBC's analysis helps investors prepare for whatever comes next.